Did President Trump just promise to slash your credit card interest rates to 10%? Hold on before you celebrate, because what he actually said might surprise you. And the aftermath could completely change how credit cards work in America forever. On January 9th, Trump posted something that sent shockwaves through the financial world. He wrote that Americans will no longer be ripped off by credit card companies charging 20 to 30% interest rates. Starting January 20th, he's calling for a one-year cap on credit card rates at 10%. But here's the key word everyone missed: calling for. Trump didn't say he's going to do it. He said he's calling for it. That's like me calling for world peace or free pizza for everyone. Anyone can call for anything, but calling for something doesn't make it happen. It's a request, not a promise or a guarantee. But let's dive deeper, because this story gets way more complicated than it appears on the surface. And by the end, you'll understand why this proposal might actually hurt the people it's supposed to help. First, let's talk about the scale of this problem. Americans are drowning in credit card debt like never before. We're talking about $1.2 trillion in total credit card debt. That's trillion with a T. Half of all credit card holders don't pay their full balance each month, which means they're getting hammered by those sky-high interest rates. The average credit card interest rate right now sits at about 22%. Some cards charge even higher rates, especially for people with lower credit scores. So, if rates were suddenly capped at 10%, Americans would save $144 billion per year in interest payments. That's enough money to fund entire government programs. Imagine having an extra $144 billion flowing back into American pockets every single year. People could pay down their debts faster, spend more on daily necessities, or finally have some breathing room in their budgets. It sounds like a miracle solution to America's debt crisis. But here's where things get interesting. That $144 billion doesn't just disappear into thin air. It comes directly out of the pockets of major banks like JP Morgan Chase, Bank of America, and Citibank. When you pay interest on your credit card, you're not paying Visa or MasterCard. You're paying the bank that issued your card. These banks make enormous profits from credit card interest. We're talking about some of their most profitable business lines. So do you think they're going to just smile and accept losing $144 billion in annual revenue? Absolutely not. This brings us to a crucial question that most people aren't asking. Can Trump actually do this? The answer is complicated, but ultimately no, he cannot do this alone. Trump could issue an executive order, but it wouldn't be legally enforceable. Banks would immediately challenge it in court and get it overturned. Why? Because regulating private lending rates requires congressional approval. It has to be voted on, approved, and passed into law by Congress. And here's the thing that might shock you. This isn't even a new idea. Senator Bernie Sanders proposed the exact same thing 11 months ago. He wanted to cap credit card rates at 10% for 5 years. What happened? Nothing. It went nowhere. Representative Alexandria Ocasio-Cortez introduced a similar bill in March of last year. Same result. It failed to gain any traction in Congress whatsoever. So why would Trump's proposal be any different? Well, Trump is apparently in talks with certain members of Congress to create new legislation. Senator Marshall mentioned discussing this with Trump and said the effort is about lowering costs for American families and reining in greedy credit card companies. But talk is cheap, and we've heard this before. Remember the $2,000 stimulus checks Trump mentioned? Or the tariff dividends he talked about? These were concepts and ideas that never materialized into actual policy. The same pattern might be happening here. The banking industry is already pushing back hard. The Bank Policy Institute released a statement saying they share the president's goal of helping Americans access affordable credit. But they argue that a 10% cap would reduce credit availability and be devastating for millions of American families and small businesses. Now, I'll be honest with you. While there might be some truth to their concerns, I think this mostly comes down to money, pure and simple. These banks don't want to lose their massive profit margins, so they're going to fight this with everything they've got. But let's say this actually happens. Let's imagine Congress somehow passes this legislation and credit card rates get capped at 10%. What would really happen next? The consequences might not be what you expect. Banks aren't going to just accept lower profits lying down. They're going to find other ways to make money off consumers and cut costs wherever possible. And this is where things could get ugly for credit card users. First, say goodbye to credit card rewards. Those cashback bonuses, airline miles, and points you love so much. They don't come from Visa or MasterCard. They come from the banks themselves. Banks fund these rewards programs because they make so much money from interchange fees and interest charges. If banks start making less money from credit cards, those rewards programs will either be drastically reduced or eliminated entirely. That 2% cashback card might become a 0.5% card, or worse, no rewards at all. But that's just the beginning. Banks would also likely make credit much harder to get. Right now, people with lower credit scores can still get credit cards, but they pay higher interest rates to compensate for the additional risk they represent. If banks can only charge a maximum of 10%, they're going to be much more selective about who gets approved. Millions of Americans who currently have access to credit might suddenly find themselves unable to get credit cards at all. Think about it from the bank's perspective. If they can only charge 10% interest but someone represents a 20% risk level, that's a guaranteed losing proposition. They'd rather just deny the application entirely. For people who do get approved, credit limits would likely be much lower. Banks would want to minimize their exposure to potential losses, so instead of getting a $5,000 credit limit, you might only get approved for $1,000. Existing cardholders might see their credit limits slashed or their cards canceled entirely. Banks regularly review their portfolios and can cancel cards they consider too risky. If they're forced to charge lower rates, they'll become much more aggressive about cutting their losses. And here's another way banks would try to make up lost revenue: fees. Annual fees, late payment fees, balance transfer fees, foreign transaction fees, and other charges would likely increase significantly. Banks might even introduce new types of fees we haven't seen before. Some cards that currently have no annual fee might suddenly require you to pay $50 or $100 per year just to keep the account open. Late payment fees might jump from $25 to $50 or more. The banking industry would also likely push people toward other financial products with higher profit margins. Personal loans, home equity lines of credit, or other lending products that aren't subject to the credit card rate cap. They might also reduce customer service quality to cut costs. Longer wait times, fewer customer service representatives, and less generous dispute resolution policies could become the norm. Now let's talk about who this policy would actually help versus who it might hurt. On the surface, it seems like it would benefit everyone carrying credit card debt, and for some people that would absolutely be true. People with good credit who are currently paying 15 to 20% interest would see immediate savings. They'd pay down their balances faster and have more money in their pockets each month. But people with poor credit might actually be worse off. Many would lose access to credit entirely. Others would face higher fees and lower credit limits. Some might be forced into alternative lending options that could be even more expensive than credit cards. Small businesses often rely on business credit cards for cash flow and operational expenses. If those cards become harder to get or have lower limits, it could create serious problems for entrepreneurs and small business owners. There's also a broader economic consideration. Credit cards provide a safety net for millions of Americans. When people face unexpected expenses like medical bills or car repairs, credit cards often provide the only available source of emergency funding. If fewer people have access to credit cards, or if credit limits are dramatically reduced, what happens during the next economic downturn or personal financial crisis? People might be forced into even more expensive alternatives like payday loans or personal finance companies. The timing of this proposal is also interesting. We're currently in an election year, and credit card debt is a hot-button issue that affects millions of voters. Some political observers believe this is primarily a political move designed to rally support rather than a serious policy proposal. Others think Trump is genuinely trying to lay groundwork for future legislation. The reality is probably somewhere in between. Trump likely knows this proposal faces enormous hurdles in Congress, but announcing it generates positive headlines and shows he's fighting for consumers. The credit card industry has powerful lobbying groups and significant influence in Washington. They've successfully fought off similar proposals for years. They'll likely spend millions of dollars lobbying against this legislation and funding opposition research. Banks will argue that interest rate caps lead to credit crunches, reduce access to capital, and ultimately hurt the people they're supposed to help. They'll point to historical examples and economic studies that support their position. Consumer advocacy groups will counter that banks have been gouging customers for years and that rate caps are necessary to prevent predatory lending practices. They'll highlight stories of people trapped in cycles of debt due to high interest rates. The debate will likely become highly politicized, with Republicans and Democrats taking predictable positions based on their broader economic philosophies rather than the specific merits of the proposal. Meanwhile, credit card companies are probably already developing contingency plans. They're likely modeling different scenarios and preparing strategies to maintain profitability under various regulatory constraints. Some banks might preemptively start tightening credit standards or reducing rewards programs before any legislation actually passes. They want to get ahead of potential changes rather than scramble to react later. The proposal also raises questions about federal versus state regulation. Some states already have usury laws that cap interest rates, but they often don't apply to credit cards due to federal banking regulations. A federal rate cap would override these existing frameworks. There could also be unintended consequences for the broader financial system. Credit cards are just one part of the consumer lending market. If banks can't make money on credit cards, they might shift their focus to other products, potentially creating new problems elsewhere. For example, banks might push customers toward personal loans, which often have different regulatory requirements and consumer protections, or they might encourage people to use home equity lines of credit, which put people's homes at risk. The international implications are also worth considering. Would this make American banks less competitive globally? Would it encourage foreign companies to enter the American credit card market? These broader economic effects are difficult to predict but could be significant. So where does this leave us? Trump's proposal is certainly attention-grabbing, and it addresses a real problem that affects millions of Americans. Credit card debt is a serious issue, and high interest rates do trap people in cycles of debt. But the solution isn't as simple as just capping rates. There are legitimate concerns about unintended consequences, and the political reality is that this proposal faces enormous obstacles in Congress. Previous attempts by Bernie Sanders and Alexandria Ocasio-Cortez failed to gain traction, and those came from politicians who generally have more credibility on consumer protection issues. Getting this through a Republican-controlled Congress will be extremely difficult. The banking industry will fight this proposal with everything they've got. They'll spend millions on lobbying, hire the best lawyers, and fund opposition research. They'll argue that rate caps hurt consumers and damage the economy. At the same time, there's clearly public appetite for action on credit card debt. Polls consistently show that Americans are frustrated with high interest rates and feel like they're being taken advantage of by financial institutions. The question is whether there might be better solutions that address the underlying problems without creating new ones. Perhaps enhanced disclosure requirements, stronger consumer protections, or targeted assistance for people in financial distress. Some economists argue that the real problem isn't interest rates, but rather that too many people have access to credit they can't afford. From this perspective, making credit harder to get might actually be a good thing, even if it's politically unpopular. Others contend that high interest rates are genuinely predatory and that government intervention is necessary to protect consumers from exploitation. They argue that banks have gotten away with excessive profiteering for too long. The truth is probably somewhere in the middle. Credit cards serve important functions in the economy, but the current system clearly has problems that need addressing. Whether Trump's specific proposal is the right solution remains to be seen, but the conversation it's generating about credit card debt and consumer protection is probably valuable regardless of what ultimately happens. For now, consumers should probably be skeptical about whether this will actually happen. Previous similar proposals have gone nowhere, and the political and economic obstacles remain formidable. But it's worth paying attention to how this develops, because it could signal broader changes in how politicians approach consumer financial protection issues. If you're currently carrying credit card debt, don't count on government intervention to solve your problems. Focus on strategies you can control, like paying more than the minimum, consolidating debt, or negotiating with creditors. And remember that if this proposal somehow does become law, it might not be the unqualified good news it appears to be on the surface. There could be significant trade-offs that affect your access to credit and the benefits you currently receive. The credit card industry is about to become a major political battleground, and consumers will be caught in the middle. Stay informed, stay skeptical, and prepare for a wild ride ahead.